Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 22nd, 2024. How you doing? Hope you're doing well. Hope you had a good trading week, and thank you for coming and watching my weekend review podcast. The format for the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back, take a look at all the trades that I made last week, both on the daily time frame and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what the signal was or signals were, strategies, confluences of signals, and then most importantly, I'm going to go through how I am going to manage the trade going forward. Always important in trading, be patient, wait for your setup. We never know if a trade's going to go our way, but we can wait and put ourselves in a position where we have a good risk to reward ratio so that if we're right, we can potentially be right big, and if we're wrong, if we do the math right and have a good risk to reward ratio, if we're wrong, we can be small, and that's really the key in trading. So we'll talk about when I entered the trade, what the signal was or signals, and how I'm going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. Really, the most important skill in trading is not chart reading or anything else. It's the ability to create a plan and then have the discipline to follow the plan. And that all comes back to trading psychology. After that, I have gone down through my master watch lists, both on the daily time frames and the weekly time frames. And I have identified some potential trades for next week on both time frames. They're not where they need to be yet, but if they get to where I want them to be, then I will consider taking the trade. It's important in trading. Patience is so important in trading, everyone, of identifying levels that you would be okay with taking the trade if they get there. And if they get there, yeah, then I can potentially take the trade. If they don't get there, I'll just forget about them, wait for a market that comes to the levels that I want. That's really, really the key. So I do have some on the daily and the weekly time frames, and we'll go through that a little later in the podcast. So let's get this U.S. legal disclaimer out of the way, and I'll be right back. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Boy, I have a lot of positions on at the moment, and with a lot of different type of strategies, which is good. It's good to have some diversity in your trading strategies. And I'm long, I'm short, different strategies, so this is all good. Let's start with Intel here, INTC. You see I have this green band here. What is this? Well, this is what is called an order block. This was the lowest low close before we had a structure change to the upside. And if you have a structure change to the upside and then come back into this is generally an area where the price is going to hold. And you can see that's exactly what happened. So first of all, when I get into any trade, I always think about the defensive part first. And I use two stops. I use an emergency stop and I use the end of bar stop. So I entered here on the 31st of May at $30.29. When I enter, I always have an emergency stop that is 2 ATRs below my entry. This is this red line. This is the entry price minus the value of the 2 ATR. This is my absolute worst case scenario. Okay, and if it does get there, then I would lose 1% of my trading capital. But the good news is this only happens about 5% of the time. The 95% of the time, if I have a loss, it is going to be my end of bar stop. And my end of bar stop, I must have deleted this right before the podcast here, is right here if we make a swing low. Now, my end of bar stop can be different depending on the strategy that I'm using, but in this case, it's right here at this, if we were to come down and take out this low, okay? So once I enter, I position size based upon the volatility. I place my 2 ATR emergency stop, and then I place my end of bar stop. Red line or orange line up here, this is, I always put this 1.5 ATRs above my entry. This is my trailing stop mode. So if I ever get to that point, now I go into trailing stop mode, which just simply means if I have a close below a previous bar's low, I'm going to exit half. So if it starts moving my way, it's a way to trail my stop, because if I were to sell half of my position, once I've got to that level, obviously it would reduce my position size substantially. And by default, it you start to tighten up your stop. Now, these are all defensive moves. The emergency stop, the end of day stop, the trailing stop mode, these are all defensive moves. Offensively, I take a partial profit of 10% of my remaining position if the price moves the value of 0.45 ATRs from the previous bar's close. For example, right now we're at 39.09. The value of the 0.45 ATR is 36 cents. So for Monday, I take 31.09, add 36 cents. That's my first profit target on Monday. I take my first profit target, add the 0.45 value to it again. That's my second. Take my second, add it to it again. That becomes my third. So I always, if it moves the value of 0.45 ATRs from the previous bar's close, and I do that 3 times because I have 3 profit targets, then I take 10% of my position off. So I always sell into strength, okay? So, and I'll go through that in a minute, but why did I enter? What was the entry signal? Well, for one, we were in the green highlighted area. That by itself is legitimately a place to buy, but I like to be a little bit more technical. What we had here on the day that I bought it is we had a V1. The previous day we had a low. The day that I bought it went below the low and then went up and went higher than the previous bar's close. So that's called a V1. I also use something that's called a V2. If you'd like to learn more about those, just go to my YouTube channel in the lessons playlist, and I have a video on V1s, V2s, but they're a great signal, entry signal to get into a trade, especially if big picture other things are lining up. So again, we had the lowest low close followed by a change in structure. We came back into the bullish fair value gap, the highlighted green area. I got in here at $30.29, placed my 2 ATR emergency stop, my end of bar stops just to close below these previous lows here, my trailing stop level here. And then again, if it on this day here on the 5th, it moved up nicely. I hit a profit target, took a portion of the position off at profitable levels, reduced my overall position size. Then we just kind of move sideways. Here on the 12th, gapped open nicely, took more profits off. Then we came back down. Here on the 17th, had a nice up bar again, took some more profits. The next day, even though it closed at near the lows, it did go up in the morning where I took more profits off. So it's very important in my trading to play offense and defense. The defense are your stops, your trailing stop mode. Your offense are selling into strength. And you can see on Friday also moved up and took some more profits off. So I keep reducing the position size. I did get to trailing stop level back here on the 12th, but since then we've never had a close below a previous bar's low. So I have not taken half. So anyway, this particular trade doing pretty good. Up to the remaining shares up 2.51%. Home Depot. All right, this is just a simple deep dip buy. These are one of the strategies that I use, deep dip buy, and it involves the major moving averages like the 300-day moving average, the 250, the 200, the 30 RSI. But you can see this is the black line here. This is the 200-day moving average. We have it's very simple. We had the previous day we closed under. On the day that I entered the trade, we closed over. Close under, close over the 200-day moving average. I entered here at 332.40. I position sized. I placed my emergency stop 2 ATRs below as always. And then my end of day stop is simply a close under the 200-day moving average. So I have a very good risk to reward ratio. If the next day it had closed under the 200, I'd simply be out and hopefully for a small loss, right? Worst case scenario, I'm going to lose 1%, but it didn't. During the day, at one point during the day, it went under, but I based these on the close and it closed over. You can see the orange line up here. This is my 1.5 ATR trailing stop level. Next day moved up, did hit a profit target, took 10% of the position off. Next day gapped way up. I hit 3 profit targets on this one. It was really great when that happens because I reduced the position size substantially. Now I have a smaller position. It's a nice feeling, especially when it's really going up and you're continually phasing out of the position. Once it gets to this level, there's really no stress to it at all. And then we move sideways. Obviously, here got to trailing stop mode, but never had a close below a previous bar's low. Here on the 18th, had another profit target up. But the key thing right now is that we're at a 67.31 RSI, which just means that now we're above the 65, or we've reached the 65 RSI level. See the thin blue line here? This is the 5 EMA. If Monday we close below the 5 EMA, I'm simply out of the trade. That's it. Done. Alternatively, if we go up and reject the 70 RSI, if we reject the 70 RSI, I'm going to take off half of the remaining shares that I have. And then if that happens, then if I get another close below a previous bar's low after rejecting the 70 RSI, then I am completely out of the trade. So, it's important in trading that you know exactly what you're going to do regardless of what the market does. We can all be vulnerable. We're human. We can get caught up in an impulsive decision, but that's why it's important that you have a process that tells you exactly what to do. So we are at some interesting levels here, 67.31 again. If it keeps going up, rejects the 70, I'll get out of half. And then if I have a close below a previous bar's low, just exit the trade. But this is a really good example of waiting for it to close back over the 200-day moving average and giving yourself a good risk to reward ratio. This particular trade so far, the remaining shares, entry to exit up 6.61%. XLE. All right, XLE, kind of similar to Home Depot. We had a close under and then a close over the 200-day moving average. Now you can see it opened up higher, went up much higher, then came down and bounced at the 200. Well, I have the support of the 200 underneath me, and I have a very good risk to reward ratio. If I'm wrong and the next day it just closes under the 200, I'm simply out for a small loss, right? Here's my 2 ATR emergency stop. Here's my trailing stop level, 1.5 ATRs above. And the next day, the 200 held and we moved up nicely where I hit 2 profit targets. So I took 20% of the position off. On Friday, it tried to go a little higher, closed a little lower, did not get to trailing stop level. Once it gets to trailing stop level, then if I have a close below previous bar's low, I'll get out of half of the position, but only if it gets there. It's not there yet. This particular trade right now, not too bad. For a couple days, up 1.16%. Tesla. Okay, well, Tesla, this is an entirely different strategy called a return to value V1 or V2. What's that? Well, here's the green line. The green line, anywhere in between the green lines is considered the value zone. First requirement is we close above the value zone, which we did. Second requirement is that we close back in the value zone, which we did. Third requirement is that we move sideways, which we did. And then we had a V2 entry. Here is bar 1, here is bar 2, here is bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. I entered here 177.10. I placed my emergency stop 2 ATRs below. My end of day stop on a V1 or a V2 is halfway of the washout bar. This bar number 2 is the washout bar. That's why this line's here. This is halfway. This is an important level that should hold. I placed my 1.5 ATR trailing stop level above. Excuse me. I entered here 177.10. Next day, gapped up huge. Took off, I believe, 2 profit targets right off of the bat, right into that strength, and did get to trailing stop level on the very first day. Well, the next day we had a big move down where this closed below the previous bar's low after reaching trailing stop level. So I did have to get out of half for a gain of 0.48%, which isn't a lot. But you have to remember that's why it's so important to take the partial profits when you have them, because uh, the 20% that I took off was up here in the 5-6% range, which is important. The next day, after getting out of half, it went right back up, which, it's still, I have some, which I'm glad. And then it moved up strongly, and I took another 2 profit targets off. Okay, so these are all at profitable. All at profitable levels. So, and then the next few days, it just kind of moved sideways and so forth. But you can see, had this come all the way back, or the next day, had this come all the way back down, how glad was I that I took some partial profits when I had them? So, I mean, 2 huge bars up. The day after I bought it, took partial profits. Then we had to move down. And then the next day, really super strong up again where I took partial profits. It's important for me to take partial profits because if it does go back the other way strongly, then it helps mitigate any losses because you took profits when you had them. So this particular trade on the remaining shares, doing pretty well, up 3.23%. Okay, UNG. I talked about this, I think last week in the podcast, and you can see the red highlighted area. This is where I was looking for a short. Why? Well, because we rejected the 200-day moving average above us. You can see we actually got right to it, had a huge reaction, strong downward move, and then we moved down strongly, which changed market structure to the downside. If you change market structure to the downside, then I want to short rallies. So I was patient, waited for it to come back up here. I considered getting short here on the 10th when it rejected the 200, but I did not because the risk to reward wasn't very good. We were quite a long ways away from the 200-day moving average. So I wanted to get something that was a little closer to give me a better risk to reward ratio. Good thing I didn't take the short here because the next day it went right up. It would have stopped me out had I taken it, but I didn't take it. But the next day we closed back below the 200-day moving average. You can see it's much closer to the 200, giving me a very good risk to reward ratio. So I did get short here at $20.82 on the short. I placed my 2 ATR emergency stop above. And my end of day stop is simply just a close over the 200-day moving average. As with any trade, if it moves my way, the value of 0.45 ATRs, I take partial profits. Next day, moved down nicely, took some profits. Next day, sideways, not much. Next day, moved down again nicely, took some more profits off the table, locked those in. Important on this day is that we got down to trailing stop level. So now I'm in trailing stop mode because this is a short. If I now get a close above a previous bar's high after reaching trailing stop level, I will get out of half the position. Next day it did. It rallied, closed above the high, but I got out of half the position with a gain of 4.83%, which is nice. And then the next day after that, moved down strongly again, took some more profits off the table, reduced my position size. Friday it didn't do much. And so, again, took half off here on the 18th with a close above a previous bar's high, locked in half at 4.83, and the remaining shares on this particular short up 9.92%. So really good trade because We had the big move down. We broke market structure to the downside. When you break market structure to the downside, I want to short rallies. Conversely, if we break market structure to the upside, then I want to buy dips, right? So hope this makes sense. Again, this is something I do teach a private one-on-one course in the evening time via Skype. It's 15 hours. And I teach my students step by step all the different trading approaches that I have. It's a really good course. If you really want to learn and improve your trading, get yourself a process and tools that you can use in any market, feel free to send me an email. We can start the discussion. But you can see a lot of different strategies here, and they don't always work, but you have the chance when they do work. You have a chance to have nice big gains like this. And when you're wrong, most likely those trades, if you're doing the math right and you have your levels right, they're going to be small. But it's a really great course, and consider it. Okay, so those are all the current open trades. Intel up, remaining shares up 2.51%. Home Depot remaining shares up 6.61%. XLE remaining shares up 1.16%. Tesla remaining shares up 3.23%. And UNG on the short remaining shares up 9.92%. Okay, so now we have the trades that I got out of. Not all trades are winners. I wish they were, but the key is, again, you're going to have losers all the time, but the key is keeping the losses small. So here is Google. I did get short Google here on the 5th of June at 175.80. Why? Well, we the same setup as UNG. We had an order block here. We had a change of structure. This is the red highlighted area here. This is where I wanted to short, and I did short once we got back to the bottom of the order block here at 175.80. I placed my trailing stop 1.445 ATRs below. I placed my emergency stop 2 ATRs above, and my end of bar stop just simply to close over this order block here 178.80. It was a weird trade. I was in the money, out of the money, in the money, out of the money. Next day it just went up against me. Next day we went down, which was good because I did take some profits off there at profitable levels, reduce the position size for the overall trade that ended up being a loser. Next day we went down, not enough for a profit target. Here on the 12th, we went above my stop but closed below it, kept me in. Next day we moved down. Next day we moved down, but never really could get this to move down whatsoever. And then on Friday, we did close above the end of day stop there at 178.10. So I had to get out for a loss of 2.1%. But the key is just keeping those losses small. It's not fun to lose that, but that's just part of the cost of doing business. You're not going to have all positive trades. So Google loss of 2.1%. And then FXY, boy, this one just never, ever worked. In the money a couple times. I got in this trade all the way back here on May 20th. Why? Well, one of my favorite approaches, this one didn't work, but one of my favorite approaches is what's called an abandoned baby or an island reversal. An abandoned baby, you can see the green highlighted bar here. We gap down and then we immediately gapped up. And when that happens, about 70% of the time, if you look into the future, you will see that if you gap down and then the next day you immediately gap up, you will see more times than not, about over 70% of the time, prices will be higher after you do that. And this one didn't work, but it gapped up, created this abandoned baby. I got long here 59.24 when we came back, filled the gap. On these particular approaches, I do kind of a set it and forget it. I place a 2 ATR stop below me, a 4 ATR profit target above me. And like I said, in my experience, 70% of the time or a little bit more, I will hit that 4 ATR profit target. 30% of the time, I will hit that 2 ATR stop loss. So 70% of the time you're making double than, well, no. 70% of the time, if you're making a 4 ATR profit target, and 30% of the time you're only losing a 2 ATR stop loss, well, that's pretty good because 70% of the time you're making twice as much money than you lose when you only losing 30% of the time. So anyway, we went down, we never hit the stop loss, we went up, we got profitable, we went down, got back up, but at the end of the day, this one just didn't work. And on Thursday, I did have to get out for a loss of 1.54%. So on the closing trades now, or the closed out trades, Google on the short loss of 2.1%, FXY a loss of 1.5%. All right, let's go to the weekly bars. And again, weekly bars, they close on Friday. That's the day that I make the decision. So IBB, you can see the highlighted red area here. Here was your highest up bar close before a market structure change. If you have a market structure change and then it rallies, that's what I'm looking to short. So I did get short back here on 517. Why? Well, one, it came inside the bearish order block, and two, we rejected the 200-day move or 200-week moving average, which is the black line here. I got short here 136.69 because the confluence of the signals of rejecting the 200-day, the confluence of being inside the bearish fair value gap. My end of bar stop is simply going to be a close above the 200-week moving average. Of course, I have my 2 ATR stop, emergency stop up here. So I got short here, 136.69, moved up against me, but then closed back down below the 200. On the week of 531, it moved down strongly, which is nice, and it moved strongly my way. So what did I do? I took some profits off, right? I reduced my position size. I played offense and reduced my position size because of the move down. And then after that, we just moved back up. We tried to close over the 200, couldn't do it, kept me in the trade. The next week, again, we tried to close over the 200, kept me in the trade. This week, we did move down early part of the week, and I did take some more profits off. But you see how important it is, especially in a choppy market like this, that you take partial profits when you have them. So we rallied into the end of the week. The trade is currently down a little, 0.52%, but the important part is that we did not close above the 200. If we close above the 200, I'm simply out. But again, this is a good example of why I really like to take partial profits when I have them, because I took some nice profits here on 531, and then this week also took some profits, reduced that position size. So this particular trade down 0.52%, which is okay. It's small, that's allowed. VIX, all right, I did get long the VIX the end of last week here at $11.21. Why? Well, we had a nice confluence of signal. We went under the 30 RSI during the week and then closed back above. We also created a V1, bar 1, bar 2. Bar 2 goes below bar 1's low, or in other words, washes it out, and then closed above bar 1's close. So this hasn't done much. 1121, I guess that's okay. It's up 0.8%. Not a ton, but better than nothing. And so I entered here 1121, placed my emergency stop 2 ATRs below. My end of bar stop is simply going to be a close back under the 30 RSI. It closed at 31.56. So as long as it closes above 30 RSI, I'm still bullish on the trade. Here's my 1.5 ATR trailing stop level up here, not even close to that. So yeah, up slightly on the trade, 0.8%, and then my end of bar stop would simply be a close under the 30 RSI. If we move up, well, of course, I'm going to take partial profits. Right now, the 0.45 ATR is 0.5. The 0.45 ATR is 0.54. So right now we're at 11.29. I take 11.29, add 54 cents to it. That would be my first profit target, and then I'll do that 3 more times to the upside. So anyway, up 0.8%. And then last but not least, Meta. Meta has been a short. Again, it's one of those bearish fair value gaps where we have the highest up bar close followed by a strong break to the downside, which has happened. Now we've rallied back in there. I did get short here at 492.96. Place my emergency stop 2 ATRs above. My end of bar stop is simply going to be a close over these highs here, 532.20. Right now, almost break even. But this particular trade on the short down 0.27%, which is fine. So those are the weeklies. IBB down 0.52%, VIX up 0.8%, and Meta down 0.27%, which is strange to have these small gains and losses on weekly bars where historically, the percentages are higher. But overall, really good week. Lots of different strategies at play, long and short. So I think it's a really good mix. All right, before we start taking a look at the trades for potential trades for next week, let's talk a little bit about trader psychology. This is from my good friend Steve Burns. You can follow Steve at @SJosephBurns over on Twitter. Pain is a great motivator in trading. And, I want to share a story. I have a very good trader friend that's been having a very difficult time trading. And kind of fighting the market. One of the worst things you can do in trading is to have a bias, a bearish or a bullish bias. It's better to just stay neutral, take the trades that based upon your technicals, what they are telling you to do. But my friend has just been fighting the market. It's been really, really painful for them. And, getting down to the point in their account where they may have to stop trading. And what Steve says here is pain is a great motivator in trading. And they have certainly endured a lot of pain. But because of all that pain, they've simply got to the point where they can't have a bias or an opinion on the market anymore. At this point, because their account got so low, now they're starting to trade correctly. They're waiting for good setups. If they're wrong, they're out quickly. If they're right, they're staying with it. So, when you have a lot of money, you can just trade and you can have all these opinions and go out there and have a lot of fun. But when crunch time comes and you're on the verge of not being able to trade because your money's running out, that's when people see the light and go, I'm going to be patient. I'm going to wait for a good setup. And guess what's happened? They're doing much better because they were forced. The pain of the losses and the pain of potentially having to quit trading has forced them to start trading correctly. And now they're doing much better. Isn't that something? So what's the lesson to be learned here? The lesson to be learned here is don't wait till you're forced to do it. Start doing it now when everything is fine. But it's a very big realization of, when your back's up against the wall and you start trading correctly, you'll see that really is the better way to do it because your percentages of wins are going to be higher. So, learn from my friend. Be as patient as if it was your last day trading on every single trade. It will really make a difference. So pain is a great motivator in trading. And for them, it was the motivation. They wanted to keep trading, so they had to be very patient, give themselves good risk to reward ratios, confluences of signals, all those things. So anyway, just wanted to share that story with you. And thanks, Steve Burns at @SJosephBurns over on Twitter. And check out all of his books. He's got great books on Amazon as well. Okay, Let's take a look at the potential trades for next week. Now here I have 7 symbols on the daily. Just want to point out, as always, that these all could potentially trigger on Monday, for example. Does that mean I would take all 7 trades? No. For me, I have a rule that no matter how many different setups or entries that I have on a particular day, I only take the very best one of the day. And what makes up the best one? The one that has the best risk to reward ratio, the one that has the most confluences and combinations of indicators lining up, which one looks best on multiple time frames, which one has the greatest or weakest relative market strength compared to the rest of the market, depending on whether I'm going long or short. This is very important. This is the devil's in the details of being able to score each trade on which one overall has the best report card. And again, this is what I teach in my private one-on-one lessons. This is really an important part of trading. Some days you can have multiple signals, but how do you narrow it down? And again, this is what I teach in my one-on-one course. And then also, actually, as an alternative to my one-on-one course, I do have a really great course online at udemy.com, the deep dip buy strategy. You saw when we were going over my trades today, there were a couple of good deep dip buys there. That's a really great place to get started. It's very, very affordable. There's 9.5 hours of video in that one particular course, 26 videos, 15 study guides, and the links in the description. But that's a really, really great place to get started, and it's super affordable. Okay, let's start with Apple. Well, okay, so Apple, you can see I have some red here. So what does that mean? It probably means I'm looking at something short. Why? Well, here we have this swing low here on the 14th. We busted to the downside. This changes market structure to the downside. So if I'm looking to, if we've changed to the downside, I want to wait for a rally, because the way that I approach this is once we break to the downside, I want to short rallies. Once we break to the upside, I want to buy dips. So here's the highest close before market structure change. You see the red line here, that would be my ideal spot. It's always a little tough with fair value gaps and order blocks to know where and when to get in. Technically, you could get it right in as we got to the bottom of the order block, but to be a little bit more strategic about it, I like this 215.60 level. Why? Because it's halfway of this big down bar. If you have a big down bar and then you rally back to half of it, that's generally a decent place. But I'd like to see it rejected. I don't want to see it just go through and close above. That's different. But if we came back up and rejected halfway of this big bar here at 215.60, I would consider taking it there. Alternatively, if we do go back up and reject the bottom of the order block, I may get short there as well. I would prefer the one in the middle of the big down bar, because then my risk to reward ratio is much better. So that's what I'm looking for in Apple. Because we broke structure to the downside, looking to short some type of rally, either at the bottom of the order block or the bottom of the halfway bar on the 18th of June. Conversely, I have some green down here. If we got down all the way back down here, I don't know if we're going to, but if we did, I would certainly consider buying the close of this gap. You can see this big gap here. If for some reason next week we came all the way back down here, got to the support of these previous highs that we broke through, which are now that were resistance, now they're support. This would make a lot of sense if it gets to 197.40. So I'm open to this. If we rally from here back into the bearish order block, I consider get short. But if the momentum keeps carrying us down to close the gap, I would get long. So open to long or short on Apple. Bitcoin, BITO. Well, Bitcoin is, obviously sold off quite dramatically. The 200-day moving average down here, the black line, this is a deep dip buy. This would be an interesting spot. I don't know if it's going to get there, but see, that's the great thing, is to be able to look at this on the weekend and say, well, that 200-day moving average, I don't know if it's going to work or not, but if it does get there and bounce off it, close under, close over, intraday rejection, or a bounce, okay, that's a decent place to enter, win or lose, because the 200-day moving average is going to attract a lot of long-term buyers, a lot of institutional buyers. But the more important thing, it gives you a very good construct to base your trade on. If it rejects the 200, get long, okay. As long as it's over, I'm staying in. If it closes under, I'm simply out. That's the line in the sand. So it's important to be patient, wait for a major level to be reached and see a reaction at that level. And if the reaction is positive, enter the trade. And then simply, if it closes under, just get out. If it keeps above, then have a process to stay in. So, we're quite a long ways away from that. We're at 22.45, so we're basically $2 away from that, but we could certainly get there. And if it gets there, then it's a good risk to reward ratio. So I'm looking for a rejection of the 200-day moving average going forward. And if it doesn't get there, then I just won't mess with it. Anheuser-Busch, Budweiser. Wow, I'm always amazed at this stock. Look at this huge rocket up. Oh my gosh, you got to have it. We have to have it. We have to have. Whoa, whoa, whoa! Never mind, never mind. All the way straight back down. Look, it looks like a teepee or a mountain, straight up, straight down. Pretty incredible. But we are getting to some levels. You can see the green box that I have here. What's important about this? Well, all the way down here, we have a bullish order block. We change structure to the upside. We have all sorts of gaps in here. So in general, I'm looking for a buy in this green area. What would the buy be? Right now, we're at 34.43 on the RSI. I like to have confluences of signals. So next week, if we continue down and reject the 30 RSI, I will consider getting in the trade, with my stop being closed back under the 30 RSI. But it's not just the 30 RSI by itself. It's the 30 RSI overlaid over this green box area is a buy area anyway. So I'm looking for it to get into the buy area, but then also get a legitimate under 30, over 30 RSI. Okay. Walt Disney. Okay, I've been talking about Walt Disney for a couple weeks now. 200-day moving average would be an excellent place to potentially take a trade on Disney. Doesn't mean it's going to work, but if it does, but if we reject the 200-day moving average, again, I have a very good line in the sand. Closes under, I'm out. Keeps over, I stay in, and I have a process that keeps me in. Okay, so we're not quite there. Green box here, we had an bullish abandoned baby because we gapped down and then we immediately gapped up. So I don't know. This might just take off from here. Don't know if it's going to get here. But the important part is I look at this chart and I say, that 200-day, that would be a good place to potentially give it a shot to enter a trade if it rejects it. And if it doesn't get there, I won't do it. But if it does, I will certainly consider it. And so I don't know if it gets there or not, but if it does, then I'll potentially take a shot at this trade. INDA, India. Oof, look at this. Look at this crazy. Way up here, way down, all the way back up. Well, I have the red box up here a few days ago. This was an abandoned baby to the downside. We gapped up, followed immediately by a gap down. So I am waiting on INDA for it to rally up, close the gap of the abandoned baby here. It's essentially about 55.30. If we do get back up to that 55.30 mark, I will consider taking a short. And in this particular type of trade, if I do get short, I'll place a 2 ATR emergency stop above, a 4 ATR profit target below. But again, why am I looking at this trade? We gapped up, followed by a gap down, making this a bearish abandoned baby. I'm not going to short down here. The risk to reward ratio is not so great. It may just continue down and then I miss the trade. But if we rally back up to the bottom of the fair value gap or the abandoned baby, bearish abandoned baby, and close the gap at 55.30, I will consider getting short again with a 2 ATR stop, 4 to ATR profit target. Lyft. Lyft was a legitimate signal on Friday. You can see the RSI is 30.42, which means we went below the 30 RSI and then closed above it. That by itself is a legitimate signal, but I like confluences. And, if we had a double bottom bullish MACD divergence, that would have been enough. But I want to have more than just one signal. And right now, you can see the purple line here is the 250-day moving average. Had we gone under 30, over 30, and under the 250, over the 250, that would have been a confluence, and I would consider taking that trade. So I'm going to give it one more day, or maybe one more week on lift. If we can close back above that 250-day moving average, then more of a confluence, then an under 30, over 30, and a close back above the 200. That's showing me probably that the bottom more than likely is in. But just with the under 30, over 30, but not being able to get above the 250-day, just going to give it a little bit more time. Now, if we go lower and reject the 300, I might take it there. So it really has to go maybe a little higher or maybe a little lower for me to get interested in. If we get back above the 250, maybe create a V2, then maybe get long here, or if it goes lower and rejects the 300, maybe get long there. NVIDIA. Well, it's been so long since NVIDIA has gone down. And on Thursday, we had a huge move down. We gapped way up high and reversed way down low. We went above the 70, below the 70. Now we've even gone and closed below the 5 EMA. That was a tight trailing stop level that I'm sure a lot of people were using. So a lot of things have changed on NVIDIA now. The close over the 70, close under the 70, but really most importantly, the close under the 5 EMA. I mean, look at here's the blue line here. We tested it, we tested it, we tested it, we tested it, we tested it. We were always able to hold above the 5 EMA, and now we have closed under this. So my thought on NVIDIA here is that we are probably, the huge moves up are probably over. So here on Thursday, we had the big down bar, and you can see I placed a line here at halfway. Remember, if you have a big down bar, if you rally back up to that halfway bar, you're going to find a lot of resistance there. Not always, but more times than not. So you can see I have the red box here that dovetails halfway here. If we come back up and reject this halfway of the big bar on Thursday, 135.10, then most likely I will get short. My stop would be a close, all-time highs there as well. But a lot of things have changed with NVIDIA, and therefore probably also with the NASDAQ as well. So on NVIDIA, again, I'm looking for a rally back up and a rejection of the halfway bar on 620 at 135.10 to potentially take a short. All right, so those are the dailies. Let's take a look at the weeklies. Oh, and hey, by the way, everybody, if you're finding any value today from the podcast and finding something that was helpful for you, I really would appreciate it if you could hit the thumbs up button. It really does help the channel out, lets YouTube know that there's some valuable content here. And so if you're finding something valuable, I would really appreciate a thumbs up. Thanks. All right, AGQ, these are on the weeklies. You have the green box here. Here's the 200-day moving average. Here is the black line. This is the 200-day moving average. If we come back down and bounce at that 200-week moving average, either we bounce right at it or during the week we go under and close back above, then I will consider getting long. You can see the last time we closed above the 200-day moving, came down or closed under, closed over the 200-day moving average. It did hold and go up. It doesn't mean it's going to do it this time, but again, it's a good line in the sand. It's a good level to test. So I'm just waiting to see if this 200-week moving average at 34.49 will be tested. If it is tested and it gives me a good risk to reward ratio, I will consider getting long, staying above it, staying in the trade if it's above, and getting out of the trade if it closes back below. Alibaba. Okay, well, green box, that probably means that's a buy area. Here was our lowest low close before we had a structure change, putting us into an uptrend. If we change structure from bearish to bullish, then I want to buy dips. We did do that. So if we come back down into the green box here between 70.52 and 67.07, that would be the buy area. If we came back down, rejected the top of that order block, I may get long there, but my ultimate level would be here at 68.70, which is halfway of the washout bar on the V2. Bar 1, 2, 3, 2 goes below bar 1's low, 3 closes above bar 1's close. That's a nice V2, and it did work out really well. But the real support on this, I mean, if I really had my druthers, right here with a rejection of 68.70, that would be an excellent place technically to get into the trade. My stop would just be a close below this low here, 66.97. So, a lot of different options. We could come down to the top of that order block at about, what did I say that was? Yeah, 77, call it 70, 50. If we came down, bounce there, that may get me long. If it continues down lower and doesn't reject the top of that order block, then 68.70, a rejection, that would be a very excellent area. Let's go to GDX, which is the gold miners. This is going to be very similar to AGQ. Again, here's the highlighted green box. This is the 200-day moving average. In the past, it did respect that 200, got right there, bounced. So in the future now, if we go down and test that 200 and reject it to the upside, I would consider getting long there. Doesn't mean it's going to work. It just means that now I have a definitive line in the sand at a legitimate support area. If it stays above, I can stay in the trade. If it closes below, I just get out. Russell 2000, IWM. Very good example of it doing exactly what I'm talking about it potentially doing next week. Here on the 19th of April, look, we were way up here. We came all the way down. We rejected that 200-week moving average with a very good risk to reward ratio. I didn't take this trade, but look, that worked really, really well. But the key is that the next week, if it just closed a little bit below, I'd simply be out for a small loss. But that support level held. If it gets down there, is it going to hold again? I don't know. Obviously, I don't know if it's going to hold again, but I like to look. If I'm looking at a level like this 200, I like to look in the past and go, did it hold? Was it respected last time? Yes, it was respected last time. It makes it more likely this time that it will respect it if it respected last time, but not 100%, obviously. So I'm waiting for a move back down on IWM. I don't know if we'll get there, but if it does, I'll consider taking a long trade in IWM if we reject the 200-week moving average. And then last but not least is Pfizer. Okay, we have a green box. It means I'm looking for something long. We had a low, we had a rally, we had a lower low, followed by a market structure change. So market structure is now bullish. I'm waiting for it to come back down into the green area. Look, it's exactly what happened this week. I didn't take the trade, but it got right to that box, and that's where it bounced. My ideal spot, and why not be ideal about it, right? I mean, nobody's forcing me to get into this trade. I want to pick really exactly what I want. What I want is 26.30. Don't know if it'll get there. Why? Because we had this huge bar up. If we come back down to halfway from the bottom to the top of that Pfizer there is 26.30. And it is in the green box. It is in the fair value gap. So that's what I'm looking for, 26.30 on Pfizer. So I hope you enjoyed this. If you did, appreciate hit the thumbs up button. If you're interested in studying with me, doing the one-on-one course, I really think you'll enjoy it. I'll teach you everything I know, all the strategies, step by step. I've taught people all over the world, from absolute beginners all the way up to the hedge fund level. So, if you'd like to improve your trading game, if you'd like to learn something new, if you'd like to learn from somebody who's traded almost 29 years, like I said, I'll teach you everything that I know. And I know you'll come out the other side of it a much, much better trader. My email is in the link of the description. So if that's of interest to you, just reach out to me. Again, I have the video course available, the Deep Dip Buy Stock Trading Strategy, on udemy.com. The link's in the description. Super affordable. It's somewhere between $15 and $30 depending on the day, but that's a great course. And if you have any questions, anything I can help you with, feel free to put them in the comment section. I'll do my best to get back to you. But I always like to leave off with, please try to go out and do something nice for somebody today. If we all did one nice thing for another human being, it really would make the world a better place. You know, if you have it in your heart to go out and try to do something nice for an animal as well, that would be twice as good. Animals appreciate acts of kindness just like we do. But I really appreciate you being here, everyone. I hope you have a good rest of your weekend. God willing, I'll be here next week. And but please be careful. You know, get yourself a process, whether I help you with it or someone else helps you with it. Get yourself a process that gives you good risk to reward ratios and that helps you be very patient with winners and very impatient with losers. So thanks again, everyone. Have a good rest of your weekend. Talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.